Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management Practical Question 38. Mr. Tamarind intends to invest in equity shares of a company, the value of which depends upon various parameters as mentioned below. They have given some 5 factors and beta for those factors, and then the expected value and the actual value, both they have given. If the risk-free rate of interest be 9.25%, how much is the return of the share under arbitrage pricing model? If in any problem, if they have given different factors and beta for those factors, then it will be obviously APT, arbitrage pricing model. But the trick is how to find the lambda. So here in our previous problems, we have seen they have directly given the values for this lambda, or we did reverse calculation and found out the factors sensitivity, or they have given the sensitivity value and we multiplied in some proportion to find out for different stocks. In the given case, they have given expected value and actual value, so you have to see what does that signifies. So obviously beta is the sensitivity of the stock towards the market return. Here we know the beta of these factors which will impact the market return, impact the stock's return. Now sensitivity, sensitivity is nothing but, let's say if the stock price is increasing by 1%, how much if the market price is increasing by 1%, how much the stock's price will increase in response to that increase in market return. That is what beta signifies. So here also, if we see, if we reduce this actual minus expected, we'll get to know the change in percentage. That change in percentage, if we multiply with the sensitivity, we'll get to know the exact market risk premium. That's what the crux here is. So the actual value minus the expected value will give us the change in value of the stock, that we are multiplying with the beta to get the change towards market return. So summation of all this plus the risk-free rate will give us the return under arbitrage pricing model. That's it. That's what this sum problem specifies. So in the first case, GNP, gross national product, because of that the actual value and the expected value is same only, there is no difference, so this beta will not affect our stock. So the difference into beta is 0 only. Because of inflation, there is a difference of 1.5%, and the sensitivity towards market is 1.75, so the change in exact percentage of the stock will be 2.63. Now interest rate is 1.25 multiplied by beta, 1.63 will be the change. Stock index 2, so 2% multiplied by the beta, 3.4. Industrial production is 0.5 multiplied by 1, 0.5. So the total changes in percentage, like total changes in percentage, or we can say the market risk premium in case of the equity share, is 8.16 in our case. And we have the risk-free rate of interest as 9.25. Adding both will give us the expected return of the stock under arbitrage pricing model, which is nothing but 17.41. Thank you.